All right, awesome. Thing is loading.
Yeah, we can see it now. There you go.
Okay, awesome. All right. So yeah, the purpose of today is really kind of helping you guys understand the difference between just tax prep and tax strategy, and more so helping you understand how you can leverage the Internal Revenue Code and presented by me, Eddy Alay. Little background about myself and how I got started. I'm the owner of Relation Accounting. I prior to being, having my own company, I did work for corporate America. I had a corporate accounting career where I was there for a couple of years, and I realized what I learned at that firm and what I was being taught and introduced to from working with multi-million dollar companies, billion-dollar corporations, is
Hello?
that a lot of those individuals pay a lot less in taxes than your average typical taxpayer in this country. So I learned the ins and outs of what I was taught, and more specifically in the real estate tax game. And just I always, discovered I had a true passion for this, empowering individuals and businesses through strategic tax planning, because I did it for a long time. And then inspired me because there were so many sophisticated strategies used by these million and billion-dollar corporations. I saw an opportunity to help everyday clients maximize their financial potential. So I do essentially what a lot of wealthy individuals already implement on their financials by paying the least amount of taxes. My job is to make sure that the average person can use those same type of strategies. I've always been driven by my desire to help others, and now I get to do it through a field that I genuinely love, guiding clients towards smarter financial decisions and long-term success. This is a problem that I want to just jump right into. I have a couple of type of strategies that I'm going to explain to you guys, and we'll talk a little bit about taxes as well. But there's a big tax problem that no one talks about in this country. And one of the biggest issues in this country is that most business owners and real estate investors believe that their accountant is saving them money in taxes, but reality, they're not. They're just filing the tax returns. You provide them with information, January, February, March, which is now basically tax season. You send them over your documents. They plug in the numbers into the forms. They send it right back to you. Here's your results. They're not really providing you a service. You're not obtaining the quality that you potentially might be missing out on, and they're not helping you create tax strategies. So just about a little over 23 million businesses and real estate investors in the US are not properly structured. And when billions is what I should say, aren't necessarily being donated to the IRS each year, instead of people saving that money and being able to keep it in their pockets, just because they're not even realizing that that's a thing. People get the results and like, oh, okay, I guess I owe money, I'll pay it. They don't really realize that there's actually something that can be done. But it really all depends on the type of scenario that you're in. Real estate being one of the most beneficial industries in the tax code. I always like to say real estate is the industry where you can make the most money possible and pay the least amount of money in taxes. And if you mix that up with a couple of other types of businesses and earned income opportunities, there's so many endless options to be able to use. So there is a lot of opportunity to increase savings. I always like to use this example when I try to explain to people the difference between filing your taxes during tax season and when we work to top of the ice glacier. This is an example of what I like to show people when I explain to them the difference between preparing your taxes during tax season and preparing your taxes essentially during the year and help working with an accountant. The top of this ice glacier is a demonstration, of what we can help you save when we file your taxes. You can reach out to us now. We can do the best that we can to make sure that you save money, but there's not really much in the sense of that can be done because whatever happened last year already happened. The bottom of the ice glacier is the potential of what can be saved with additional planning if we start working together on a regular basis during the year. With the right strategies, entity structuring, cost segregation, deductions, and tax planning, there's a massive opportunity to reduce tax liability and keep more money in your business and investments instead of giving it away to the IRS. So tax benefits from homeowners when it's your personal residency. A lot of people start off buying a house that's their personal residency. You want to buy that investment property. A lot of people don't do that. They end up getting their own, or it's a mix of both. But when it comes to individual taxes and your personal residence, certain home-related expenses can be deducted or provide tax benefits. And here's just a couple of a breakdown of what you're able to claim. There's mortgage interest deduction. So any interest that you pay on your mortgage principal, essentially a majority of that can be written off if you itemize your deductions. The property taxes that you pay on the property, up to $10,000 for the year. I know a lot of states tend to have high property taxes, and it's just the limit as of right now, the $10,000. It's something that is, in my opinion, might be adjusted in the upcoming months with the new tax legislation that's happening. So there's a chance that it could increase. Mortgage insurance premiums, home office deduction if you are self-employed or you work from home, energy efficient tax credits. There's certain types of eco-friendly investments that you can make towards your house that are able to give you a tax credit, as well as solar panels. Solar panels give you a 30% tax credit as well for, let's say, a solar panel system costs, random number, $100,000, you get a $30,000 tax credit right out automatically, and points on mortgages. When it comes to tax benefits for real estate owners, in this case, investment properties, real estate owners enjoy more of a tax saving opportunities than most individuals because the tax code rewards property investment and management. You know, the top 11 tax deductions for real estate owners, just to give you a couple of, is also just a little bit of what was discussed. A couple of the deductions, you know, mortgage interest, depreciation, property taxes, repairs and maintenance, day-to-day operating expenses, travel expenses, home office deduction, bonus depreciation, Section 179 depreciation, capital gains deferral, passive activity losses, equipment and appliance deduction. So it's very, like, it's a big difference between what you're able to write off when it's your personal residency versus when it's an investment property. When it's an investment property, ideally it's seen it's a business. So it opens the opportunity for you to be able to write off much more deductions than the average typical personal residency, with the opportunity to also create losses. To give you guys a little bit more of understanding of everything, I do have a couple of examples. So understanding Internal Revenue Code Section 167, depreciation. Depreciation in a normal terminology is seen as, like, you know, wear and tear, the value in something is going down. And on the tax side, in the tax industry, depreciation is technically the same, but it's used as a favorable tax strategy, tax benefit, because if you have a property used in trade or business, or, you know, property held for income production, real estate depreciation, you're allowed to deduct the average wear and tear over a span of 27 and a half years if it's a residential property, 39 years if it's a commercial property. So an example can be, let's say you guys buy a property that's $1 million. Typically, there's a property value of the building and the land, so it's allocated between two, usually 80 to 20%. At times it is different, but we'll use 80% for this example. The property value, the building value of this property is $800,000. You can deduct $29,000 every single year for 27 and a half years because, like, without even having any expense. You're starting the year off with negative $30,000 essentially. And this is with every piece of real estate, any type of fixed asset, more specifically, real estate being one of those beneficial industries that you're able to use the depreciation heavily for. So it's a key saving tool for real estate investors. Most of the time, when you earn income with rental properties, because of the depreciation and all the expenses that come with it, you're able to create a loss, if not bring your income down to zero. And that essentially creates a loss that's able to flow through other sources of income. And just to talk a little bit more of depreciation, because there's ways to maximize that amount instead of spreading it out over 30 years, 27 and a half years. And this is a different type of strategy similar to it, known as the cost segregation analysis, and you're accelerating your depreciation. And what a cost segregation study is it breaks down the property into components. So someone goes into your house, they nitpick certain parts of the house, floor and window, fences. Okay, instead of you writing off the whole purchase price over 27 and a half years, let's pick out certain parts of the house that we can accelerate and write off in year one, up to a certain percent. And not most of the time, so potentially in full, depending on what happens this year, but up to a certain percent. So to give you guys an example, let's say a $1.5 million property. The building value is $1 million. On a regular basis for depreciation, you can write off $36,000 every single year, no matter what. That's automatic as long as you do the calculation the right way. If we perform a cost segregation analysis, that's going to help us select certain parts of the asset that you can write off of a bigger portion in the first year. And it can be anywhere between 10 and 30% of the building's value. So you go from writing off $36,000 to potentially writing off $100,000 to $300,000. And that is a big expense that's going to get placed on the tax return compared to, like, let's say you guys make $50,000 in rental income, giving you a $50,000, $250,000 loss on the tax return. that you're able to essentially eliminate the entire taxable rental income, potentially creating a loss, if not most likely already creating a loss, to offset other types of income, such as your W-2 income, 1099, business income, depending on your tax eligibility. And of course, there's certain thresholds that have to be met. You have to make a certain type of money under a certain type of amount. So you may or may not have to be in certain tax brackets. But there's a lot that can be done to get away from the thresholds. And normally for real estate, the rental losses are considered passive, and you can only offset on passive income. So the IRS allows an exemption on rental real estate, up to $25,000 of a loss. If you make anywhere between 150 under that amount in gross income, you can take a $25,000 loss on your real estate. So going back to what I mentioned before, if you create a $100,000 loss on your real estate portfolio, but you don't necessarily fall within the threshold, you make too much on your salary, job, day-to-day operations, you may not even be able to write off $25,000. You might just be able to stay at zero and just carry the losses forward to the following year. If you're under the $100,000, you're actually able to write off up to $25,000 of a loss, and whatever the difference is, you write off from the prior years again. There is a way around that, though. There's two alternatives. The one that's one of them is getting into the Airbnb business. That could potentially help you out, having short-term rentals. There is no threshold for that, because Airbnb businesses are seen as essentially a business. It's more of a business than it is passive income, because you're continuously in operation, communicating with the people that are staying. You're actively restocking everything. At times you might be cleaning or making repairs. But if you're not the type of person that likes to invest in Airbnb and short-term rentals, and you love long-term rentals, there's another option that you could take, which is known as the real estate professional status. The real estate professional status is an election that you can make, and it's a big game changer, because it removes the $25,000 loss cap by treating rental losses as non-passive and essentially allowing you to just write off the full loss and offset the income everywhere else. So there's no threshold. You don't have to make between a certain amount of money. You don't have to, have a certain type of tax bracket. As long as you have the loss in full, $100,000 loss, if you elect real estate professional, you can use that loss to offset your other income. However, there are certain requirements that you have to meet in order to qualify. You must spend 750 hours per year in real estate activities. I'm sure most of you are realtors, and you probably spend that amount in a week. So most of you probably already qualified for that. You need to have more than 50% of the total working hours in real estate. So you can have technically 2 full-time jobs, but your real estate job has to be way more than what your other job is. And it has to be about 51% of your overall time. So that kind of takes away the 750 and makes it a different type of category. But you at minimum has to be 750, and you have to materially participate in rental operations. One of the things that I always talk about is for someone like, I'll give it myself. I'm, accounting firm, tax advisor, owner. I'm a real estate investor myself. I use the tax code to the most possible way to be able to save money on taxes, but I am not able to use this election because my full-time profession is, accounting, tax advisor. I spend too much time on this versus the real estate. Unfortunately, I don't qualify. Airbnbs, on the other hand, allow me to be able to deduct my income. Or another alternative is if I'm married, which I just got engaged actually recently, and this is for the future, I plan on, my wife to be the real estate professional of the family. She is going to manage the real estate portfolio while I take care of the accounting business. She is going to meet the threshold for the 750 hours. She's going to partake in all her time in real estate and manage everything on day-to-day operations. That automatically, because we're married, the IRS sees you as one person. So if the spouse is the real estate professional, that means the spouse's income or losses get combined with the other taxpayer spouse's income or losses. So if my wife is a real estate professional and she generates losses on the portfolio, that portfolio can offset the income that I make on my business, or vice versa, depending on the scenario. So being married and when you're for a tax spend, it can be very, very beneficial in a tax standpoint. So there's no passive loss cap with this. Offset rental income. Again, you go back and you use the cost segregation, it creates an even larger deduction, reduces or potentially eliminates all of your taxes. And it just allows you to keep more of the money that you make from your investments. And you're able to reinvest it into your business, reinvest it into real estate, and many real estate agents and investors already qualify for this without even realizing it. With the right structure, this strategy can unlock significant tax savings if you invest it correctly into your business. Another gem that I like to know about, that I like to talk about, and I think most of you or some of you may know about it already, is Internal Revenue Code Section 1031, known as the tax deferred like-kind exchange. When you own investment properties, a lot of individuals tend to, sell their properties once it's gained in value. They want to cash out. They want to get their profits, right? A lot of people are worried about the taxes that comes with that. Most of the time, that investment that you're looking to sell and make the money out of, you're going to most likely invest it again. You're most likely going to use that money and put it into another investment, another property. There's a way that you can mitigate that investment. And instead of having to pay the taxes on the gains now, you can defer the taxes to the future by selling this property using Section 1031, finding a replacement property, a property that is very similar to this one, and purchasing it within a certain amount of days. So essentially, you're just exchanging properties. You're selling one, you get the money. The money is held by, let's say, a QI is what we call it, in a separate bank account. You have 45 days to identify a replacement. Not necessarily to close, you just need to find a replacement. And you have 180 days to close on the replacement property from the day that you sell it. So just about a half a year or so. And then you replace the property, you get the new property. The money that's held in your account is used to purchase the new property. So you can essentially sell a single family, 2-family house that's gained a lot of value, and you can use that to buy a 4-family, a 6-family, potentially maybe a smaller apartment complex. Because of the bigger gains that you made from it, you're able to give a higher down payment, no taxes paid whatsoever. The only thing is it's deferred in the future. So if you sell that other property in the future, then you may have to pay taxes on it, but that's something that you can worry about at that point, and you plan for it ahead. So it's a very powerful strategy for real estate investors to preserve the capital and growth while tax efficiency. So instead of having to worry about the taxes, think of it as tomorrow's problem, several years from now. Internal Revenue Code Section 121, the home sale capital gains exclusion, and this relates to personal residencies. So if you have a primary residence and you live in it for 2 years out of a 5-year span, so let's say from 2020 to 2025, doesn't have to be 2 years in a row. Any time between that frame, you lived in that property 2 years, you qualify for this exemption. And the way it works is, if you're single, the IRS gives you $250,000 of gains tax-free. So if you make $250,000 on the gain of this sale of this property, if you're single, essentially you will not pay any taxes on it if there's no depreciation, recapture, or other things you have to worry about. And if you're married, it doubles to $500,000. So if your property, let's say there's a $600,000 gain, and you're the type of individual that you lived in it for 2 years, you want to sell it, you're married, the IRS will let you write off $500,000 of that gain. So on paper, your gain is only $100,000. And there's other ways that you can probably write that off too to reduce it. It's just a matter of you keeping track and records of all the repairs and improvements that you've done over the years on that property to help write that off as well, on top of closing costs from the selling and the purchase, on top of attorney fees, accounting fees. It's a business on that specific transaction. When you own personal residency, there's not much that you can do with it except the itemized deductions. Once you sell it, it becomes a full-on business. And everything tied to it, every expense that you had related to it, you're able to use and write off on top of the capital gains exclusion. Internal Revenue Code Section 288, the Augusta Rule. This one is very unique, and I like to consider it something that we use a lot for a lot of business owners. Because Section 288 of the Internal Revenue Code allows homeowners in any income bracket to exclude up to 14 days of rental income from their taxable income. So if you have a property, you have a beach house, you have something in the mountains, and let's say you rent it out for $500 a day, only 14 days out of the year. It's maybe your primary residence, you're going on vacation, you want to rent it out while you're gone for 2 weeks. You're going to be able to claim, or you're going to be able to obtain $7,000 of rental income from a stranger or your business if you decide to rent it out to your business during the year for like quarterly meetings, monthly meetings, board meetings, events, whatever the case may be. And on the business side, you can take a $7,000 deduction for writing that off. And on the personal side, you don't have to claim that income. So you're saving taxes on the personal side and on the business side, essentially. So you're able to take $7,000 out of the business, pay yourself. The $7,000, you don't pay any taxes on it. You get to write off the $7,000 on the business. It's a win-win scenario, So there's other properties that are a lot valuable. There's other properties that are a lot less valuable that you're going to rent. It all depends on what the fair market value in that area is on a daily basis. And this is something that's very unique that people are able to use. I want to give you guys a couple of examples of the types of clients that we've helped. This is Ed. He's the owner of the Mexi Boys. Ed, it's the way we worked with Ed. He came to us in about 2020, 2021. He had an old accountant who was stuck in the past. You know, they used to print out the tax forms, fill it out by hand with a pencil, mail it over to the IRS. That's like 20, 30 years ago in time of the way that the IRS and accountants used to work. That's not common anymore. I was actually surprised that I saw that. And the fact that the person that used to prepare it did it wrong and prepared the math the wrong way, essentially missing deductions and depreciation, he was overpaying in taxes. So Ed had a passion for his business. He had a vision for the growth, and he needed smarter tax strategies. Thankfully, he reached out to us. In just 1 year, the first year that he came working with us, this is back when he had one truck that he bought at an auction. Now Ed is on his way to buy his 5th food truck, and this is in a matter of four years or so of working with us. He has 4 Mexican food trucks. Today he was calling me. He's going to buy ice cream food. He's buying a food truck to make it an ice cream business. So Mexican food spot, ice cream business right next to each other. Pretty clever. But the first year that he worked with us, we helped him save $75,000, and it led to him getting a $50,000 refund from the IRS. And he reinvested that into his business, and he used it to buy another truck or to pay more advertising or more services. We've been running the same play every year. We're doing the same thing this year. It's not $50,000, but it's definitely in the five figures range. Yeah, 5-figure ranges. So it's very close to it. And the way we were able to do that is because Ed has a mix of business and he has a mix of salary W-2. So his salary W-2 takes money out of his paycheck every week. His business is generating losses, similar to how I mentioned about the real estate, taking advantage of what's available, generating losses that are created and lumped in with the business. So he could be making, random number, $100,000 salary. His loss from his business can be $100,000. Combining that, you're looking at $0. So on your tax returns, you would report $0, and every dollar that was withheld from your paycheck during the year, you would get back as a refund. And that's kind of the smartest strategy that we've been able to maximize for him while he's still in corporate America before he eventually branches off and fully divulges time to the business. This is Alex. He's a part of the Jersey City Luxury Group. He is someone that might be similar to a lot of you, if not the people that you might know, but he's a real estate investor, and he is also a real estate agent. His previous accountant missed a lot of key saving tax strategies for investors. Luckily, real estate is my niche. By using a lot of the stuff that I mentioned just a couple of minutes ago of the strategies we implemented for him, he's on verge to save well over 6 figures for the prior year, or that we're about to file 2024. And 2025 is going to be probably the year where he pays little to no money in taxes. Best year yet, because he puts the money that he makes as a realtor, invests into real estate. The real estate allows him to have tax favorable benefits, lowering his taxable income, obtaining a savings on that he's able to keep in his pocket and reinvest that money again into more real estate or other tax favorable strategies. And that's the game. That's the plan of the game. You have to be open-minded. You have to be willing to use the money that you save and invest it in somewhere else that'll help you make more money in the future, but provide a tax savings on the current day. So it's either, I always tell people, it's up to you. You can give 30 to 40% of your money can go straight to Uncle Sam, or you can use that money instead and make an investment that'll make sure you don't pay 30 to 40% in taxes. And just a quick quote that I always like to look at this, because 90% of millionaires become so through owning real estate. I don't know how many of you know that, but a lot of the richest people in this world own real estate. Real estate creates a very, very good portfolio that increases and appreciates over time, as many of you know. I prefer real estate over the stock market just because not only the income that it makes, I always think of it as like a high yield savings account in a way, and it pays you dividends if you have rental income. But I always look at the tax side of it too, because it's a big tax saver at the same time. So you're saving taxes, buying real estate, making more money, increasing your wealth. And that's the game that all the rich people and celebrities of this country do. And a lot of individuals that are my clients, I tend to push them into it as well, eventually going from 6 figures to 7 figures, 8 figures, and so forth and so on. And that's all I got for now. I do have a little bit of information over here if you guys are interested in learning more about what we offer. We do post a lot of content on social media. That's actually how Brandon met me. And I think we were going a lot back and forth. He saw the content. He saw the value. a lot of what I preach on social media and what I show you guys today, it's what I do on a regular basis for my clients. So we help people save a lot of money on taxes and build wealth at the same time. If anybody is interested, we do offer free consultations. I can drop the link, or maybe Brandon can email it to you guys at some point, but maybe I can put it in the chat right now. But this is what I have for now. If you guys have any questions, I'll leave the floor open to you. You can ask me whatever you want.
Yeah, Eddie, you can throw it in the chat. I will be sending out the recording, the deck. I'm gonna have fun editing the recording. Yeah, I'll send all that out for you. But do you have some time just to answer questions that people might have? I think everybody's kind of booted, so I could open up the chat, or people could come off mute.
I have a question.
Yeah.
Hi, my name is Jose.
Hi,
I have a
Jose.
tax person, and I have 2 Airbnbs. So, but we can talk more. You know, I'll sign up for your free consultation. Should my tax person know all these rules and regulations, all these niches and stuff like that, or they have to be that good?
Technically, they should, but the way that the tax profession was, I would like to think, earlier on in life, going back to like maybe 10, 20 years ago, pre 2017-16, which a lot of professionals are stuck in the past. They're very compliance heavy. So they're not strategical, and they don't keep up to date with the new, I don't want to call them trends, but the new tax laws, the new policies, you know, like that's always been a part of the tax code. It's just they're more popular nowadays because they've been boosted up and they've been giving more like in 2017, Trump changed the tax legislation. He made it very more favorable for real estate investors and business owners. Maybe the tax person you work with now didn't keep up with that up until now, and maybe that's why they may not know about it. But there's also a lot of individuals that just don't understand what's in the tax code, and going back to they're just preparers, you know. So they're just, you give them the information, they plug in the numbers, here's your results. Ideally, because you have 2 Airbnbs, you should be talking to your accountant at a minimum every quarter and see how you can maximize the Airbnbs to create potential savings. So it's very different. You know, there's typical tax preparer, tax person, and there's tax advisor, tax strategist that's willing to take the extra mile to be able to help make sure you save money.
Yeah, because here in the Chula Vista home, I pay property taxes, I pay tax at the end of the year, I pay the Chula Vista short-term lease taxes, and then I pay Airbnb taxes, and my mortgage is $3,000. But if I'm making, you know, $5,000 a month, yeah, $2,000 we're still putting back into the house due to supplies, but they're still charging me the $3,000, and that doesn't make any sense. I'm paying my mortgage. That's not free money. I'm not pocketing that money. So that I'm still kind of confused when it comes to that. And then the one in Vegas, I pay just property taxes, Airbnb taxes, and also I pay property taxes at the end. I don't pay a short-term lease tax out there in Vegas. So I know I'm losing money, but why am I being taxed on my mortgage money? I'm already being taxed on that. That doesn't make any sense.
So it's essentially you're paying the property taxes. You know, that's it is what it is for properties all over the country. You have to pay that for depending on where you are, the value of it. When it comes to, you know, the Airbnb tax and like the additional, we can call it sales tax on certain states that you're charged on based on what you make. Ideally, you want to make the income, like if it's what do you charge a night for one of the properties?
Right here in Chula Vista, I say average $200 a night during the week, and then on the weekends about $300.
Okay, let's say $300, right, for the weekend. From those $300, you have to pay out the sales tax and the thing that adds up on Airbnb and everything else. That's what you're referring to, right?
Yeah.
You have to plan in a way where you're either charging it or including it in that fee, so you don't see it as an expense. Because just with any business, I always explain to people the way sales tax works. When you sell goods, in this case, you're selling a night at your Airbnb, your rate, whatever it is, that's your rate. The counties, the cities, the states, they're always going to want their cut, but it's not a fee that's going directly towards what you're charging. It's a fee that you technically should be charging the person staying. Like you go to a hotel, for example, they'll charge you $500 a night. Then there's resort fees, there's occupancy fees, there's the taxes. A lot of those fees aren't necessarily for the hotel. They're for to pay out every other department that's charging them these additional fees. That's one thing, the way to look at it. I know it's very hard to compete probably with the other Airbnbs if they're not doing it, but that's kind of the way you look at it. On an income tax standpoint, though, I'm very, very positive that you could probably save a lot more money on
No, I
that.
know, and I'll contact you through your Instagram. It's my son's Instagram. So when
Okay.
I message you, I'll put Jose Mesa.
Okay.
His is Gay Mesa.
Okay.
I'll message you, and then I'm gonna have my other son. My other son is the one. He's 26. He's the one doing the Airbnb. So me and him are actually gonna sit on that conference call with you,
Okay.
so he can understand it better.
Yeah.
I'm 50. I'm retired. I want to enjoy life. My son is 26. This is his project.
Okay.
But I also want to understand more of the concept of trying to save money. But we'll be in contact soon.
Of course.
You know what I mean? I'll shoot you a message, and then from there we'll figure out a time and
Yeah.
date for all three of us to get together.
Yeah, and if you want, I did post a link on the chat somewhere that I'll do it again, but just so you can kind of look at, I have a Calendly shows like availability. You can go through it. You can just pick something, or you can message me on Instagram. Whatever, whichever one works. You'll have.
I'll message you on Instagram. So yeah. I got to get with him and see. Are you available on the weekends or just during the week?
Mostly during the week, but I tend to make things work. If we need
and
to
then I'm doing the week. What's your latest appointment? Because he gets off work like at 4:35.
You are in California, right?
Yeah, I'm in California.
What time would you need to speak?
If he can get to my house, he'll be here by 5:30 p.m.
Okay, I can make that work. We'll talk. I always am willing to adjust. If anything, we can always do a Saturday.
I appreciate your time, Eduardo.
Definitely, no. Likewise.
Take care.
You too.
That is helpful for you, Jose. Alex had a question too.
Oh yeah, hey, I kind of missed the part where you went over and you were talking about whether it's a long-term or a short-term, like what the differentiation is from a tax perspective. And like I have a single-family home with an ADU in the back, so I don't do Airbnb. I have it listed on Airbnb, but I typically do like Furnished Finder, where it's like short to mid-term rentals, like 90-day rentals at a time. Okay. And I just wanted to kind of hear those clarifying rules on like Airbnb versus long-term rental. Or short-term or long-term.
So for Airbnb, it has to be on under a certain amount of days. You said you do 90-day listings?
My minimum is 30 days, but I'd say my average is around 60 to 90 days, somewhere in that mixture.
That's like we can consider that a mid rental, but on a tax perspective, that would be considered a long-term rental.
Oh, okay.
So, yeah, for Airbnb, it's usually like less than 7 days, less than 14 days. The average has to be like a smaller amount. So it has to be similar to like a hotel where you're like consistently flipping it to be more considered a business versus someone that's kind of staying there longer. It doesn't really classify as a business per se, even though it is treated very similarly.
Okay.
I got a question.
Yeah, I think Cristiano had a question as well.
Hi, Eduardo. Cristiano here. Thank you for your presentation. Very insightful. I was wondering if you provide a service like financial advice, or when it comes to real estate investing. For example, let's say someone is considering investing to real estate but doesn't know if maybe going to another state, and navigating through all the tax implication, the pros and cons. For example, I'm in California, for example, myself, and how expensive real estate is, all the taxes related to it. And I'm now in a position I kind of say maybe I want to buy for myself, like house hacking types of situation, living in one unit, renting out the other, maybe doing Airbnb in the other, maybe using the capital to invest into another state where I get like better cash flow. So I'm wondering if you also, guide clients to determine what could be a better solution for them based on the states or personal situation. Is that kind of service you provide, or you're more just focused on, the tax implication?
Yeah, so it's funny that you mentioned that, because I have I like to consider him a partner who actually does that. He resides in Arizona, but he specializes in real estate advisory, and he helps individuals essentially hey, you want to move to New York? You want to move to Florida? Like, I'll give you the best case scenario based on the market, how much money you would pay, how much money you would save leaving California. And I jump in on the tax savings. So we kind of like partner up on it. And I'm able to help you understand how much money you'll save on taxes by doing that, and kind of being able to give you an additional understanding on the income side of it. He is more of like the advisor, helping you find out what state will help you understand where you need to go based on what your current budget is and whatnot. So definitely something that I can connect you with.
Okay.
Yeah.
Perfect. Thank you. Thank you.
Of course. I mean, if you want to, whenever you want, email, message on Instagram, or make an appointment, I'll make sure we get that information to you. I'll talk to you, and then I'll have him talk to you as well.
Where are you located?
I'm actually in New Jersey.
Okay.
So yeah, right next to between New Jersey, right next to New York.
Okay. Thanks.
Eddie is nationwide, but a big part of his business is here in California. So he's really well versed in California tax law as well. Just in case that was confusing.
California is the third top third state that we serve. Number one being between New Jersey and New York. California being number 3. We help clients virtually like all over the country. It's just a matter of you guys wanting to make the change of in-person to virtual. A lot of people aren't comfortable with it. A lot of people enjoy it very much more. It's very simple. You just hop on a Zoom call, phone call, and we do everything virtual. Emails, client portals, make your life easy and simple.
Can I ask one more question?
Mm-hmm.
As you can probably tell by my accent, I'm Italian, and I just got my American citizenship now. And I know there are implications when you have income from, abroad, Europe. So do you cover those kind of issues with foreigners, dual citizenships type of situations? And is that an area you're knowledgeable about?
Yeah. So you invest overseas, or you earn money like in Italy, basically, right? Is what you're saying?
Yeah. For example, I might be having like income from real estate in Italy, and I know that you may need to report to IRS, regardless of where you reside. Let's say go back to Italy at some point.
Yeah.
So
that's definitely how you're right on the money. Once you're a citizen of the United States, if you make income anywhere outside of this country, you have to let the IRS know. And at times there are certain tax complications that you need to meet. A lot of additional foreign filings that need to be met. That is something that we can help you with, though. I'm not my specialty. I do understand it very well, but I have someone on my team that specializes in international tax. So we would both of us would speak to you and help you get a better understanding with it.
Thank you. Perfect. Thank you so much.
Of course.
If anybody else has questions, you can come off mute or raise your hand, whatever works for you. And then, I'm just going to switch this here, Eddie, real quick.
Yeah.
Go here. If you guys could send over either what your biggest takeaway was or any challenges you expect as far as implementing kind of what he said and taking advantage of some of those tax laws that help you, or if you have suggestions for ways to make this better outside of screening who attends better, just let us know. You've got all my contact info here. And then also in that bottom right corner is just a link to all my contact info. You could save it. You could either text it to me, email it to me. It's just really helpful to know what was helpful for you, what's valuable, and then what you might struggle with or what you might like to see different. But other than that, like I said, I don't want to take up your whole day. I like to let everybody get back to what they're doing, but appreciate you joining, and I hope it was helpful.
Definitely. It was very, very good to be here. Thank you for having me, Brandon. And again, any questions at all, Brandon has my information. You guys have my info. Reach out at any time. We offer free consultations. Willing to help all of you save a lot of money on taxes and not fill up Uncle Sam's pockets.
Definitely. Really appreciate you, Eddie. Have a great rest of your day too, and appreciate you.